What's up, everybody? Crypto Noah back with another passive income strategy video, coming at you 5 days a week with a different strategy on a different chain or protocol on how you can put your idle blue chip assets and stablecoins to work to generate passive income. In this video, we're going to be talking about Maverick protocol. Maverick protocol is a decentralized exchange that has some pretty cool things optimized for liquidity providers like ourselves. So if you like this kind of content, I ask that you consider subscribing. Join our Discord to ask me questions. I always reply with a personal video. Also, if you want to learn this skill that I teach on this channel, how to find the best opportunities in DeFi, generate passive income, mix it with trading, and just learn how to become a well-rounded investor, click the link in the description to book a free strategy session so we can get a good idea as to what your goals are, where you're trying to go to see if we can meet you, and if this is a good fit. Now, before I get started, last thing I have to say is this video should not be taken as financial advice. Please consult with your financial advisor before making any investment decisions. This video is for your education purposes only, and like we always say, do your own research, but use this channel as a starting point. In this video, we're going to break down the docs, all the things you need to know regarding Maverick. We're going to go through their smart contract audit, their tokenomics, all of their liquidity strategies for liquidity providers, and all the cool incentives that they have to go along with the platform, some strategies, the risk. We're going to cover all that stuff. And then at the end, if you stick around, I'm going to tell you if I would use this platform or not. So without further ado, let's dive into the docs. All right, so they have everything you need to know on the docs, how to make a swap. That isn't anything different from Uniswap. Let's start going through what you need to know in regards to being a liquidity provider. All right, so it goes on to tell you that each pool consists of 2 tokens. This is standard. They also have concentrated liquidity, so you can do single-sided in the beginning, and you see it says that here. I'm not going to say in the beginning until it goes within range. It's the same thing with Uniswap here. They do things a little bit differently, though, but kind of like the same. They just allow you to track different things. It says an LP's liquidity is distributed using a series of bins that correspond to different price ranges in a pool. Prices in a pool are a reflection of the ratio between the 2 tokens in that pool. The widths of the bins vary from pool to pool, and they are set by the liquidity provider who initially deploys the pool. LPs add liquidity to particular bins in order to execute a particular liquidity strategy. So I know this sounds confusing, but I'm going to make it all make sense here. So if you look at this picture here, each one of these bar graphs is a bin, and each bin represents a certain price. So price can only be inside of one bin at a time. So they allow you to put price within price ranges and bins. So it says at any one time, only one bin in the pool is active. This means that swaps are actually occurring at that price using the liquidity in that bin. As the ratio in the pool changes, the price will move to a new bin, making that the active bin. LPs only collect fees when they own liquidity in the currently active bin. When a pool is first deployed on Maverick, the deploying liquidity provider chooses a fee tier in addition to bin width. So if you look at these bins, each one represents a price point or a price range, it sounds like, but you can choose how wide you want to go in the bin. So you can select a bin and decide how much you want to be in it. A liquidity provider collects fees based on their pro rata share of the current active bin. Any fees earned are auto compounded back into the pool, and so the LP's position in the pool grows proportionally. When an LP exits their position, they redeem their proportional share from the bins in which they are staked. All right, now it goes on to talk about pools versus positions, and we're going to go through, there are 4 different modes, and this is going to make this all make sense, but just for context, let's go through this. So it says when a user deposits liquidity into a Maverick pool, they select from several options to open a specific position in that pool between the token pair, fee tier, bin, width, liquidity mode, and liquidity distribution. Each user's position can be heavily parameterized and therefore very different from all other liquidity providers on Maverick. Even within the same pool, users might have their liquidity staked at different price points under different liquidity movement modes. All of these variables make up a user's position in the pool, which is highly customizable and specific to them. So it's basically like price can be between $100 and $200 on an asset, and people can be within the same range but have different things set up to where even if the price is doing the same thing and the person is providing liquidity within the same range, one person can still be doing better than the other based on the tools that they have here. So now let's talk about some of the risks. So obviously you have impermanent loss risk. I'm not going to go into that too deep, but basically if you're in the ETH USDC pool and it starts to go down, it's basically a limit order for the losing asset. So As the price is going down, it's going to be buying ETH as it's underperforming, and as the price goes up, it's going to be buying USDC as it's underperforming, and the loss is impermanent because you realize the loss when you exit the pool, not once you sell. However, they also have something called permanent loss. Let's dive into this. Maverick uses permanent loss, or PL, to describe the kind of risk specific to both positions. And these are the modes that they have that we're going to get into. It's different from impermanent loss in that it represents a real and immediate loss to the liquidity provider's reserves, not a theoretical loss pending withdrawal. PL can occur in both positions because the LP is agreeing to buy high and sell low as the liquidity is responded. If the price in the pool swings back and forth, the LP can end up buying high and then selling back low, thereby leaking value from their liquidity position. For pools with very wide bends, the risk is mitigated because it will take larger price swings before PL becomes a factor. And you have to remember, with the wider the bends, also that decreases your APR. So, there's always a trade-off. You want to keep that in mind. And if you want to learn more about PL, you can click this document, and it goes to this and it explains it in great detail. I'm not going to get into that one here. If you want to learn more, obviously you can come on the website and read it yourself. They also have something called unwanted movement risk. So it says in a well-functioning pool, there's a substantial amount of static liquidity that facilitates the movement of directional liquidity bends and makes arbitrage straightforward. This protects liquidity providers in movement modes from bad actors who might otherwise try to manipulate the TWAP, which is time-weighted average price, that governs liquidity movement in Maverick AMM. Simply put, with sufficient static liquidity, it's very difficult to exploit the TWAP. Sounds so funny. As arbitrage should counteract any wild swings in the price pool. This is partly why Maverick requires users to always start with static liquidity when deploying a new pool. If it doesn't have enough static liquidity, this can expose movement mode LPs to unwanted movement risk. So if you want to learn more about this, read through it. But basically, the less liquidity it has, the worse it is. And that's why liquidity is the most important thing when it comes to trading, providing liquidity. Like, for anything to happen in this pool, there needs to be enough water. And that's for people who want to swim, people who want to dive, people who want to build coral reefs. You get my analogy. All right, now let's get into their modes. So it says Maverick AMM comes with 4 out-of-the-box liquidity modes for you to choose from. This is how you can optimize your liquidity position. And it says each of these modes are designed to facilitate a different kind of liquidity strategy, with the first 3 relying on Maverick's AMM, pretty much their AI, to keep their liquidity active. And all of this is controlled by the smart contract, and liquidity is moved based on the time of the time-weighted average price in the pool. And it's different depending on what pool you're in. So let's get to the first mode. The first mode is mode right. And this ensures that your liquidity is only following the market price to the right. So if you look at this here, it shows price moving and your liquidity is following, right? So if you're in the ETH USDC pool and you provide liquidity in mode right, let's say ETH is $2,000 and you go from 2,000 to 3,000, you get to ride that all the way up, and it helps you when price is increasing. And it's gonna kind of touch on that here. So it says a movement to the right would correspond to an increase in the price of one of the 2 assets in the pool, in this case, the base asset, as their ratio is changed by trading activity. One would expect this to happen if there was an increased demand for that asset, leading to more people coming to the pool to swap it out for the other. So it says mode right is designed to follow price movement in a single direction, allowing liquidity providers to execute an active liquidity strategy that takes advantage of upward price trajectories. It says the goal of this strategy is to generate fees for the LP without incurring much impermanent loss. Essentially, an LP uses mode right to make a bet on the value of one asset increasing against another. If their bet is correct, they can follow the price to the right and capture fees as it moves. Now, they pretty much said it here. If you're betting on a price of an asset to go up and you want price exposure as well as to generate passive income, because you don't think this is good if you don't think price is going to go up too fast, because one thing about this, their tracking isn't as strong as like APY Vision or like a Revert Finance where you can see everything. So I think based on my knowledge that I have on yield farming, as long as I have, if the price is increasing gradually, I feel like it'll be better than this if the price just did a hike up. Yeah, and it pretty much says that. I should have read this first. To be effective, the strategy relies on the fact that price movement isn't rarely linear. Instead, the price of a token The pair experiences a range of micro adjustments even as it moves in a discernible direction. The next mode is mode left, and it's pretty much the opposite of mode right. It'll only follow the market price to the left. All right, so this is a good one to be in if, let's say ETH is at 5K and you think it's gonna go down. The only thing is when markets correct, they usually correct down faster. When you're looking at a chart or a market, is fear and greed, and people's fear of loss is higher than their desire to gain. So that's why the uptrend, while it is explosive sometimes, it's usually more gradual, while the drop is sharp. It's kind of like a roller coaster. So let's say ETH is 5K, you think it's going to go down to 3. You can provide liquidity from 5 to 3. And the whole time it's going down, you get to generate fees from that position. So this also can be used for if you think the price is going down, and as a way to buy the dip and get paid to buy the dip. And we made a lot of videos on that, using yield farming as a way to generate passive income while it's sitting in a limit order. The third mode is mode both. Your liquidity follows the market price to the right and to the left. And obviously this is better for like choppy markets. It says here, if the price continues to move in the same direction into new bins, the AMM will continue to reconcentrate the LP's liquidity to follow it. If the price should rebound in the other direction, the AMM will first allow the LP to get swapped through completely and then begin reconcentrating the LP's liquidity to follow price from the opposite side. The purpose of this mechanism is to keep the liquidity provider's liquidity as close to the current price as possible at all times. And it says here, the risk of impermanent loss with this mode is higher than either mode right or mode left, since the LP is exposed to it in both directions. Moreover, they're also subject to permanent loss by implicitly agreeing to sell underperforming assets at any point in time. Mode both can therefore carry a significant measure of risk. So basically, this is for a market that's chopping, but not like crazy chopping. Like you don't want it going up 100%, down 100%, up 50, down 50. You want it maybe up 5, between, a move of around 10%. So that way you can concentrate it in some bins that isn't too far apart, but isn't too close to where you're experiencing so much impermanent loss. Like you want it wide enough to where it kind of stays in it the whole time, so it doesn't have to buy and sell. Because if you just keep doing that, eventually, you'll probably run out of money depending on how it's performing and how much capital you have in there. The last mode is static, and this is pretty much concentrated liquidity. It says here it allows you to add liquidity without engaging any of their AMM's liquidity shifting mechanisms. You can add liquidity to a range in a bin and it'll stay there regardless of price. Now, the cool thing is when you select mode static, you get an option of 3 default distributions. The first one is exponential. This starts with the concentration of liquidity around current pool price and spreads the rest of your liquidity in exponentially decreasing amounts across the bins to the left and right. So let's say you want to provide liquidity from here to here. Wherever the middle of it is, it's going to make that the highest, and it's going to have it exponentially decrease on both sides, if that makes sense. The second option you get is flat. It distributes liquidity evenly across a range of bins centered around the current pool price, similar to constant product AMMs. So like I said, you get to put liquidity across bins, but also you can control how much you want in each bin. And you can do that here. And the last one is single bin. If you want to put all your liquidity in one active bin, you can do that too. And then it says for both the exponential and flat, the user can also specify the percentage of the price range they wish to cover, and the UI will select the appropriate amount of bins based on bin width and current pool. So basically, you don't have to have it exponentially distributed like on this hill type vibe. You can have it evenly across the bars and evenly distributed as you want within the bins as well. So full optionality here. They go on to show you how to add liquidity, which is pretty standard, how to deploy a new pool, which is pretty standard. They show you how to check everything. So they give you some tools to check them. It's not like APY vision, but it's better than nothing. Show you how to manage it. They give you some liquidity strategies. They kind of tell you when to use which modes. You can kind of go through all this and get a bunch of strategies if you're interested in that. They give you the advantages and the drawbacks to each one, so you can tell they're kind of taking it serious. All right, now let's dive into their boosted positions. So boosted is just how it sounds, just like you go on Gamma, and let's say you're in the ETH OP pool, and the creator of the pool, which is Optimism, they want to offer extra OP as an incentive for people to provide liquidity in the pool. That's the same thing here. You can get into pools where they have extra incentives so you can earn yield from trading fees, but also from the bonuses from the creator of the pool. So that means like if you want to create your own pool and you're trying to like sell your token, you can create a liquidity pool and have some incentives on the side. That's not something you can do in Uniswap. Maybe, I'm sure you'll be able to do it with like their rollout of Uniswap hooks, which I made a video on, and why I think that's going to obliterate all dexes. But, you know, I think that's pretty cool, like that they have that built in. It shows you how to join a boosted position. It's pretty self-explanatory. We're going to do a platform walkthrough, and I'm going to show you where the boosted pools are. It shows you how to create a boosted position as well as how to manage a boosted position. And it talks about how you can create a pool with a boosted position. Let's say you want to give away 700 USDC over a TWAP of 7 days. So that's $100 a day. If someone comes in after you and they don't put as much as you, let's say they add an extra 200, instead of that being 100 days for 7 days, that's 100 days for 9 days. But if they put more than you, now they have a say over the incentives and the how long they'll be given out for and the amount. They also have advanced tutorials. They have a lot of information here. Next, let's go to the tokenomics. Just being transparent, I do not own any of the MAV token. I don't plan on buying any. But for someone who's considering it, I'm just talking about this section so that I can give you all the data. So it goes into the allocation here. You had 1.5% going to Binance, 18% going to investors, 16% to the public goods fund, which is pretty much a team in my eyes. Liquidity mining and airdrops, foundation, treasury, aka team, and then advisors. So, you know, 19% to the team. I've seen better, I've seen worse, but when you factor in the treasury and like, you know, public goods fund, I don't know, it seems like the team to me. I'm not sure. It's one reason why I'm not buying the token. And also, you know, I think there are just more projects I'm bullish on from a token standpoint. Nothing against this project. I love what they're doing. Then you have the token release schedule. So you can see around August 2024, that inflation has been pretty heavy, and it's only going to get heavier up until about 2027. So that's something to be aware of if you're considering buying this token. You know, you can stake MAV and get access to voting and all kinds of different things if you're into that kind of thing. They tell you how to stake. They give you details on the preseason airdrop. I'm not sure when this was written and if this is still going on, but if you're into that, look into it. And then they also kind of talk about this leaderboard here. Next thing, super important, whenever you're allowing a smart contract to interact with your wallet, you want to make sure that smart contract is safe. One way of doing that is seeing if they have smart contract audits. I'm not going to go through all these on camera because in an effort to keep this video short, but you know, they have 5 different audits. There's been things that were vulnerabilities that they have fixed, and that's a good sign. It's one thing to get an audit and then to just slap it on the internet and say we got an audit, but it's another thing to pay for an audit, get told of your errors, pay to fix it, and then pay to get another audit. And to do that 5 times, it shows that they're pretty serious. The only thing I couldn't find was how they make money and the fees that they charge. You know, I'm not using this protocol right now, so I can't even, you know, just being transparent, like tell you what they are. But that could be a red flag, because the only thing about these kind of platforms that, you know, I have a problem with sometimes, and I don't know if this is the case with them, and I guess I can't really lump them into the category all the way, because they're not just like a Gamma where they, you know, are fully managing it. Like this is like a hybrid, kind of like Aperture. Like even though you can bet on the price going right and left or stand with it, you still have some sort of control. But the thing about those platforms I don't like is that they make money regardless of if you make money or not. Like a lot of people have complained about LPing on Gamma. Let me know if you guys want me to make a video on Gamma. LPing on Gamma and being in a pool where it's like 100% APR for a while, and when they take the money out, they either have less or the same amount, is because the platform takes money every chance they get, regardless of how the pool is performing. They're making money on the fees, and they're not affected. That's kind of the same thing as a mutual fund. They make money regardless if your portfolio does well or not. And if you've watched my channel for a while, you know I'm against mutual funds because over 90% of them underperform the indexes. So now that we talked about that, let's do a brief platform walkthrough and see where everything is and how it works. Also, I forgot to go through their last thing on their token before we get into the platform walkthrough. It's 31 cents right now, market cap's 78 million. It's showing the price all the way back since June of this year. I didn't bother pulling it up on TradingView. It's 51 cents, now it's 31. So yeah, I'm not planning on buying this token unless something changes. I'll let you guys know. All right, so here we are on the website. You scroll down, it goes through all the modes here, have some articles that you can check out. One good thing is that they have some pretty good backers, some pretty good investors. So Pantera, who's one of the top VC funds, Jump Capital, also one of the top, Apollo, Binance Labs, Circle, Coinbase Ventures. I'm not familiar with all these. Gemini Exchange. So they have some pretty good backers. That's a good thing. So now let's launch app. Simple DEX. You can connect your wallet. These are the chains they're on: Base, BNB, ZK Sync, and ETH. So you got the standard DEX. Here is the boosted position. So you scroll down here, and whatever you want to sort by, whether if it's volume, you click volume, or APR, and it shows the top boosted positions based on APR. So it gives you the pools. This Pendle one looks pretty lit. I might consider actually getting in this one. So this APR is including this extra 150% APR. And it tells you how you're getting rewarded. So ePendle and Pendle. So it looks like the reward token is actually just the same token. And it even tells you it's a static pool. This one's a both. So these are all the boosted pools. And then you just click pools. And let's see what kind of pools they have here. So I want to sort by APR. Got MAV ETH for 1800% APY. If you're into that. MAV USDC 138%, Blur ETH 44, ETH USDT, that's not bad, 28.9%, USDC ETH 26.74%. You got the ePendle, but we saw we had the boosted one on there, so it might be a better idea to go to the boosted one if you're getting paid the same for the same risk. So yeah, these are some of the pools. They have other pages that we can go through as well. And if you look up here, they have a TVL of 31 million, 24-hour volume of 16 million, and total volume of 10 billion. Now that we've done the walkthrough, went through all the fundamentals, I'm going to tell you guys if I would use this platform or not. The answer to that is, it depends. However, I'm not using it now. So let me talk about why I'm not using it, and I'll talk about the situation where I would use it. The reason why I'm not is because I would prefer to use Uniswap. While it is cool having the mode right and the mode left, it's just not enough volume in the pairs that I want to provide liquidity for. If I wanted to use a tool on when to get out, when to get in, and different things like that, I use Aperture Finance. The tracking is better in APY Vision and Revert. And like I said, volume and TVL is the most important thing. I can make way more money with not a lot of risk on a protocol that is battle tested, that is one of the top protocols in all of DeFi. And there's other platforms I would use ahead of this one as well. So it's not just because Uniswap is better in terms of volume and TVL and security and that Lindy effect. Another thing, in regards to the mode right, the mode left, and the both, I feel like these are for a more advanced liquidity provider, and most liquidity providers aren't advanced. If you want to become one, go ahead and join our Discord and book a strategy session to see if you're a good fit for our course. Anyway, yeah, it's things that is way harder to predict with the average tools and knowledge for people who are out there doing this kind of stuff. And I feel like that keeps people away, and the more it keeps people away, the less users, which is the less volume, aka the less money that we can make. For example, if I go on DeFi Llama, I can see that Uniswap has a TVL of $4 billion. And in the past 24 hours, they've paid out 2.3 million. You can see in 1 day, 7 day, and 1 month, it's been increases, right? Maverick's TVL was 31 million. Now, I went down here to see if they would be tracked on here, but they're not. But if they were, they would be number 194, 195, right? So it's why would I use it if Uniswap or these other protocols are an option, and now you have things like Aperture on Uniswap. Now, there are three situations where I would use this. One is if the volume in TVL increased and I felt like it was worth it. Two is if there was an incentive on there that made me want an LP. So like, let's say there's a project that I believe in and they're saying, hey, we're creating a pool on Maverick. If you jump into this pool, we'll boost it and now you get rewards of 50 to 100% APR or something like that. I would definitely come on and farm there. Like I said, they do have 5 audits, so I don't think that they're going to get hacked, although it's possible. And the last situation where I would use it is if I wanted to create a pool and I wanted to create an incentive so that people can come trade within the liquidity pool. Like I said, Uniswap hooks are probably going to enable that, but you're probably going to have to be a developer or wait till someone builds it. Maverick already has it out of the box, so if I wanted to utilize that option, that would be a reason why I would come and use the platform. So with that, I hope you got value from this video. Let me know what project you want me to cover next, what strategy. Let me know your feedback if you like this kind of stuff. Like I said, join our Discord, book a free strategy session. I thank you all so much for watching, and I will see you in the next video. Take care.